Hey everybody, this is Matt Ackley, Chief Marketing Officer at Ritchie Bros, and welcome to another edition of our Inside Edge live industry panels. Today we're bringing back a I'll call it a cast of characters that's been with us before. We're back by popular demand. We're going to talk transportation today. As I think we've all seen, the world continues to change, right? And that's, I'm actually sitting over here. I'm coming to you from cold and snowy Sweden, right across the Baltic Sea from Russia. And so, obviously we'll talk a little bit today about how that conflict is having an impact on, stuff we see in North America. And so, as we get into today, right, we're using a little bit of a new technology here. We're using a GoToMeeting. So thank you for joining us. If you've got questions, please type them into the question box. We love questions, and we'll try to answer them in due order as we go along. So with that introduction, let me introduce, I think, a bunch of people that probably don't need much introduction to those of you who've been here before, but I'm going to let the panel introduce themselves. We're going to go left to right across the screen, or as they say on your radio dial. So Steve, let's start with you, and then let's do some introductions, and we'll get into it.
Thanks, Matt. Appreciate that. I'm Steve Tam. I'm Vice President at Ackley Research. For those who might not be familiar with the company, our sole focus in life is trying to understand what's going on in the commercial vehicle market, predominantly in North America. I've been in the industry for just about 30 years now. I've been with Ackley Research for 20, and we've been closely following the used vehicle market for probably, I want to say, 15 at that time. Company's been in business since the mid 80s, and again, all we do is commercial vehicles. So, Tim, tell them about you.
Hey, Steve. My name is Tim Denoyer. I'm a senior here at Ackley Research. My primary focus is on the transportation sector, the freight markets. We do a monthly forecast, forecasting truckload, LTL, and intermodal spot and contract rates. And I've been with Ackley Research for coming up on 5 years, and prior to that, I have a 15 years of background in the investment community doing equity research on the U.S. industrial sector.
My name is Rob Slavin. I'm a senior valuations analyst with Ritchie Bros. I've been in the industry, transportation specific industry, for about 30 years. And that's my primary focus here at Ritchie Bros. Is transportation, heavy truck, medium, dumps, trailers. Josh?
Perfect. My name is Josh Lazerson. I've been with Ritchie Bros. For a little over 10 years. And when we started the strategic accounts transportation vertical 6 years ago, started in that vertical and get the live, breathe, and remarketing of transportation for our customers. Over to you, Matt.
All right, excellent, guys. And so, as you can see, great mix of, Ritchie Bros. Experts plus some outside experts. So we're gonna jump right into the state of the transportation industry, because we always like to bring that global view. And Steve's gonna take us through kind of what's going on today, which is always interesting. Steve, take it away.
What a mess this market is right now, Matt. At its core, what we're trying to do in our business is figure out demand for new vehicles. And it's made up of two parts. It's pretty simple. You need to look at what's out there in terms of the fleet and vehicles and trailers that are available to do the work, and then what the work is, whether it's freight or construction, you name it. And typically, it's not a hard job. It's not rocket science. It's truck science, right? And it's really all about replacement demand. That's what normally drives what happens in the space. This cycle is completely different. Demand is white hot. We all know that. Economies are on fire. We dumped $4 trillion into the U.S. economy during the pandemic, and we're still trying to spend all that money. And of course, that's been very good for our markets. This time, it's been all about the supply, right? We can't meet that demand, and unless you live under a rock, you've probably seen this list or some derivation of it. stuff is just in short supply. And, you know, Matt, to your comment earlier about, you know, what's going on in the Ukraine, one of the new things that's back at the top of the watch list, or, you know, maybe still at the top of the watch list for a different reason, is microchips. You know, we thought we were making progress in the semiconductor front, and we're, instead of coming out of the woods, now I think we're going back into the woods. Reason for that, neon gas. It is an ingredient that is used for the production of the silicone chips. It's used to etch them. It's called lithography. And unfortunately, about 50% of the world's neon gas comes out of the Ukraine. And so we're not going to put this shortage behind us anytime soon. The good news for the used truck market, of course, is that, you know, the limited ability to manufacture and deliver new trucks means it keeps supply tight, right? In 2020 and 2021, we shrank the fleet, so we retired more trucks than we added because of the challenges that we have. And so that just puts pressure on the demand for used trucks and sends those prices higher. So Rob will talk a little bit more about that pricing a little bit later on. But there, you know, the takeaway is there are still dozens, if not hundreds, of parts that we're keeping an eye on that are limiting new truck production. We expect a little bit of progress this year. We should be able to build more trucks in 22 than we did in 21. Fingers crossed, but it's not a slam dunk. So
it seems like we've been singing this song for a while now. Yeah, and you know, the world just keeps getting, you know, it's just getting more complex, right? And so you know, with all the interdependencies, so we'll see. Hopefully, you know, hopefully this situation over here, you know, we hope for a number of reasons it comes to a you know, a peaceful compromise or something like that. So.
absolutely.
Next slide.
Yeah, so Tim, I think you were going to talk about what's happening with the sales, unless you want me to. So 6 1/2 does the other. Tim, your audio is cutting out, bud. Yeah, let me jump in and speak on Tim's behalf here. So you can see kind of where we were in terms of retail sales. This is just tractors for the U.S. market that we're looking at here. And it's the challenge is, of course, we're still, you know, at below replacement levels. Now, the good news is, you know, we do see sales picking up, as I mentioned, with regard to the production forecast. Truckers just can't get new equipment fast enough, and they certainly can't get it when they want it. So I think the message that I want to communicate with respect to the sales side is that rest assured the demand is there. Freight is doing very well. You might be hearing in some of the popular press that things are starting to slow down, and that's true. But it's growth rates that are slowing down. So freight, at least at this point, and at least throughout 2022, we expect it to stay the same way. We expect to see freight continue to grow, just at a slowing rate. So you're starting to see that balance or that equilibrium about, you know, the amount of trucks that are available to do the work and what that work is. I hope I don't have to give Tim's whole presentation. I guess we'll see what happens.
Why don't you get another shot, Tim? See if we can hear you. We're still
Tim, turn off your microphone and restart it.
Yep.
Hello?
There we go.
There we go.
Dang, I'm unmuted. I've got a red.
We can hear you fine now.
Now you're good.
Oh, sorry about that. But so the one thing I would add on this chart is really just that relative to that replacement level.
We're really having problems with his. Yeah, you're cutting out again, Tim. Why don't we hit to the next slide?
Okay.
Steve, can you maybe you can jump in here and.
Yeah, I don't have. There we go. Here we go.
Yep.
So this slide speaks to the point that I was talking to earlier. What's happening on the freight side? So it's been, I don't know, probably about 6 months or so ago. Tim can give me a thumbs up. We took over the forecast for the cash shipments index. And we're doing some pretty decent analysis, in-depth analysis with them. And you can see, if you look at 2021, focus in on those blue bars at the bottom of that chart, just the stellar strength in freight growth coming out of the pandemic. And then also, if you look back over the long tail or the history of that chart, you can see we were in 2021, the absolute level of freight was above where we have historically been, 2018 notwithstanding. So, fast forward to kind of where we are today, and my comment is that, freight is continuing to grow. It's just that the growth is not going to be as robust, right? When you're looking at record high levels of freight, it's hard to top that. It's the same story or the same song, right, that we're singing on the used truck valuations. When you're paying top dollar, it's hard for that level to keep increasing. So good strength here, good support, good underlying demand. It's just the industry's ability to actually satisfy that demand that's so daggone frustrating in the cycle that we're in right now. You can see there was a pretty good dip in January. That was just a hit from Omicron. So as we started locking down again, especially in Asia or in China, we had that disruption to the shipping lanes that we've also been dealing with, unfortunately, for quite some time. But we recovered pretty quickly in January. Now, of course, they've got another lockdown going on right now, so we're gonna have to keep.
Yeah, I was gonna say the news coming out of Shanghai is really not that good right now either. So.
And the lockdowns are somewhat draconian. I understand, the desire, and you can characterize it however you'd like. But the net effect is, if they shut their ports down, stuff's not coming out, and it's not headed this way. So it's disruptive for the freight flows here and the business that we're talking about. Let's see if Tim can enlighten us any further on that. Oh, he's muted still.
Doesn't look.
Yeah.
Speak. You gotta talk.
Yeah, no, it's a difficulty sometimes with the new technology. We tried to use a different approach this time.
Yeah.
Just like the pandemic times. Oh, did we hear him?
He's in and out. Yeah.
Yeah. All right, let's go on to the next slide, and we'll try to keep moving along, and maybe it'll resolve itself.
Yeah. So spot rates are where we look to understand where the balance of capacity is, right? If you've got rising spot rates, you've got increased pressure on the network. So that can either happen because the fleet's getting smaller or the work is growing faster than the fleet. And then, of course, the flip side of that's true. So you can see, again, the massive run-up that we had as a result of capacity in the 2020 timeframe. Still very, very rapid growth in 21. But you can definitely see the change in the slope of that curve, right? So the growth started to slow down. And now we are actually at the point where we've added a lot of new capacity. You hear about all the operating authority that has been issued during the past year and a half. That's a lot of new truckers entering the space. I think a lot of them being seduced by record high freight rates.
Yeah.
Good money, right? So we're getting closer and closer, and then we're continuing to add. Now, unfortunately, in this industry, we have a really bad habit. We always overcapacitize the market. So whether freight's staying the same or contracting, we're going to put too much equipment out there. That's then putting the downward pressure on spot rates that you're seeing right now. These actually don't include what's happening in the fuel price run-up that truckers are dealing with right now. So this is just a pure freight number. So you can see rates have already rolled over. But look, we're still on a year-over-year basis well above where we were this time last year, and significantly higher than any place we've ever been in the history of the industry. So still, supports, I think, ongoing consumption or purchases of used trucks, at least through this year. We'll, again, have to keep a finger on what's happening in the Ukraine, what's happening with COVID. But a relatively bullish but hyper vigilant outlook, I guess, maybe is
even with fuel prices where they are. Yeah.
So now part of the thing with fuel prices, right? If you're a fleet, you've probably got surcharge mechanisms in place that are going to protect you, maybe not 100%, but at least largely insulate you from the fuel price run up. They tend to lag. And of course, you don't collect surcharges on deadhead miles, right? So that part's not going to be protected. It's a bigger challenge for the small fleets and for the true independent owner operators to try to recoup that. So it is going to, unfortunately, it's going to lead to some folks exiting the business. I get on my soapbox every once in a while and I tell them, it's great to see that rate at, $2.75 or $3 a mile, whatever it is. That's fantastic, but you need to know what your cost is, right? What it costs to run that truck, and you need to know what you're going to do when freight rates drop, like they invariably do. So we will see, bankruptcies. How bad it is just depends on how quickly things turn down and how closely the truckers are paying attention.
By the way,
Hey,
you guys
Steve, I have a question.
you think the price of gas is high in the U.S. once you come over here to Sweden and check it out? You have to take out a loan to fill up your car.
You guys pay for a liter, pay for a gallon.
Yeah.
Steve, in a normal market, how much would you say of the market's freight is based on contract versus spot? Is it contract rates fill 80% in a normal market, and maybe that's gone up to 35% spot rates in this market?
That's a good point, Rob. And traditionally what happens when capacity is tight, you actually see shippers move more freight under contract so that they can guarantee that capacity. Yeah, so we're probably, I don't know, Tim can nod his head yes or no. We're probably 85% or maybe even 90% under contract right now. I don't see Tim's head moving, so he's it's sideways. So yeah, that's kind of strong agreement or disagreement.
So a lot of the dealers that I'm talking to and the customers that they're bringing in are living off the spot rates, right? They're living off that high dollar. And that's why they can afford to pay what they're paying for trucks today. We'll get into that, but the numbers are, I know that this increase in fuel is going to certainly dampen their ability to make the kind of money they were making 6 months ago, but still, as you said, significantly above where we were.
That's right.
Do you think there is a magic number where the spot rate hits that it will have a direct effect immediately on used truck pricing?
There's typically a lag. This industry is famous for, being, I guess, maybe from Missouri. So you get one data point, and that might get people's attention. You get a second point and everybody kind of sits up and says, oh, something's going on here, but then they want a third data point to confirm what they're seeing. So, if you're looking at monthly data, you're a quarter in before you even think about, okay, how's this going to impact my business and how am I going to react to it? So I would say, it has been interesting because we expected the turn to happen maybe a little bit sooner, and so this cycle has actually outlived its normal life cycle, I guess. Not by a tremendous amount, but at the margin it has. And so, and we're starting to hear, and it'll be interesting to see what Rob has to say or hear what Rob has to say, but we're starting to hear, at least at the margin or at the fringe, that pricing is cooling off a little bit. So less desirable trucks are not bringing as much money as they were. Maybe you can get that 7-year-old truck now for what you were paying for an 8-year-old truck a month ago or 6 weeks ago.
It's a lot higher than that.
Yeah. What's that, Rob?
I said it's still way up there, but yeah, we're gonna start to see it cooling off. But I think that if new truck manufacturers can't get what they need to build trucks, if we build what we built last year, I think we can see this continue to drag on and see higher values. Maybe not the numbers that we're seeing right now. I expect to see some cooling off, but with the supply chain issues, the neon, I just talked to one OEM that gets their wiring harnesses from Ukraine, and I can guarantee you there's no wiring harnesses being built there right now, right? Nothing's being shipped over.
Wiring harnesses are always in short supply in this industry for some reason. I don't know.
Yeah.
But you make a very good point, Rob. That's exactly right. It is the challenge on, putting new equipment into the fleet that has caused the cycle to get stretched out a little bit this time. There's
Whenever you see a big Go ahead.
I was going to say there's one other dynamic that has kind of factored into that. And if we can flip to the next slide, I want to talk about the labor markets a little bit. If that's not what your question was about, Rob, go ahead.
No, we're good. Just, yeah, let's keep going here. I want to hear about labor.
Okay, so what you're looking at here is the supply side, right? So on the left-hand side, we're looking at truck transportation employment that comes out of the BLS, and it represents, I don't know, maybe a third or 40% of the total employment, because you've got the private fleets who are not in here, and then you also have the true, again, independent owner operators who are not part of this process. And you see, you know, the immediate hit that we had post-pandemic, and then the climbing out of the trench since then. And we have finally surpassed our pre-pandemic peak. It's interesting to note that we were actually in a imbalanced situation then. We still did not have enough trucks for the amount of freight that we had. So we're not back to equilibrium. But what's really, I think, telling about what's happening in these dynamics right now is the slide on the right. That's local trucking employment. So a significant portion of the growth that we've seen in truck transportation has been for local haul, right? It's not been for that long haul or for that regional haul market. And so that's part of the reason, again, that the cycle has been extended and that demand is so strong for, especially, you know, in the Class 8 sleeper market. You know, you see run-ups in all of the markets, but it's that market that lives or dies by freight and then, you know, by the balance of capacity. So.
Oh, it's as we switch to the next slide. I mean, another pretty solid jobs report today. So, you know, I mean, Lisa, you know, maybe we're seeing people come back into the market, you know, from the Great Resignation. But you know, I think that's gonna factor into a number of different things. All right, so on the next slide, we, you know, once again, let's, you know, speaking of the labor capacity, right?
Yeah, exactly. And this data comes out of a survey that we do. We've got about 50 fleets or so that range in size from, you know, 10 trucks. Well, I can't say 10. Let's see, how do I do this? 5 trucks to 5,000 trucks. So everything from owner operators to the big for-hire national carriers, right? And basically what it shows is exactly what I just talked about. It's just kind of a microcosm of that broader picture. It's getting, the situation is improving, right? We're able to add drivers to the marketplace. But again, and we don't have a tremendously long history on this series of data. We're going to overshoot the top, right? We're going to have too many drivers in the marketplace. We're going to have too many seated trucks chasing after a waning amount of freight, which is just going to kind of accelerate that downturn on the rate side. And it's what defines the cycles in this industry. I mean, we've seen it time and time again. It just it's, you know, wash, rinse, and repeat, so to speak.
It's the classic adage, you know, the free market solution is never a good solution, but it's better than any other solution out there.
Sure.
What I find interesting about this slide is when you think back into in general terms of repossessions, when we had those high improving times, those were the highest repossession times that we saw. So, you know, if we continue to improve, I fully expect to start seeing some repossessions hitting very soon.
Yeah, and that's a good point. You know, driver availability, you want to balance it, right? But we never do. We never get to that point. It's always, you know, we're either shooting up through it or crashing down from the top end to the bottom. So sad but true.
Okay, okay, so we've talked about, you know, some of the, you know, the macro stuff that's going on, and, you know, we always appreciate that perspective, and, you know, great conversation on spot rates. That's kind of new information for folks out there. Let's see, you know, Rob, why don't you take us through how all this is translating into pricing for used trucks. And I think we're going to be singing the same song we've been singing for the past, you know, year or so again here.
Right. So, right. 30 years I've been doing this, and of those 30 years, I would say the majority of that, you know, 18 of those 30, or I'm sorry, 25 of those 30 years have been in used truck. And in that time frame, I have never seen prices increase to the level that they have. If you go back over the last 10 years, you may see from year to year things jump 20% from a bad year to a good year, kind of in a correction mode. But the levels that we're seeing today are it's just crazy. And it all started, in Q1 of 2021. We knew that there was going to be, short supply of equipment based on what was going on with new truck. So we anticipated it, and we weren't necessarily at the top, coming off of Q4 2020. And each quarter we have seen prices jump every quarter, which, that's not typical, right? You're always looking at a declining market from a used truck standpoint. You're fighting the battle of supply and demand. And with no supply and plenty of demand, numbers have jumped up dramatically. And even in, quarter over quarter, which is what I typically look at, looking at the median price, January to February, 32,000 versus the previous quarter being 26,000. And of that, there's been a kind of that typical 10% to 15% increase. I like looking at everything on a more mile for mile based on age year, and I have an example of that coming up. So no different really in Canada versus the US. Canada's numbers have jumped up quarter over quarter. I'd say we're a tad above them in terms of what we're collecting, but it's not far off. Let's go to the next slide. So the most popular age we sell is a 2016. The most popular truck that we sell, the most frequent truck we sell, is a Freightliner. They have market share leadership, which doesn't surprise me in terms of that being the most popular truck. So if you look at January, February of this year, of the sales that we've done, it's jumped up to $75,000 here in the US on our live sales. Previous quarter, October through December, was $68,000. The mileage hasn't changed that much, 592 to 671, but still that's a dramatic increase, and an increase that you would never expect to see in a more normal market. So yeah, it's like I said, nothing we've ever seen before. Let's go to the next slide. This will give you a taste of where we were and where we are now. So when you talk about 2016 and you look back from it being a 5-year-old truck, and you're just saying, I lumped all units in that were 400 to 800,000 miles. And what we've seen over that 5-quarter time frame was 149% increase. That's about $45,000 across the board. And the largest increase was on 650 to 699 mileage. That increase was over 52,000, and I think it was 189% increase. The average back in Q4 of 2020, that being a 5-year-old truck, it was somewhere around 27.5. That's jumped up from the last sales that we've had, up to $79,500. So those were some people paid top dollar for those units, and there wasn't a huge amount, which certainly helped that whole supply and demand situation. But the numbers, like I said, are just absolutely it's mind-blowing, really. We have the sales guys like Josh, kind of pounding on me saying, hey, we can't think about what it was last quarter or what we collected for trucks last quarter. We have to start looking at what it's going to increase or what it has increased over the last 2 and 3 quarters, and take that in consideration. And you tend to, when you're starting to spend money, you get a little nervous when you're having to increase things 15% on a $60,000 truck. You're talking almost $10,000 more than what it was the previous quarter. Next slide. So van trailers, as a percentage of sale price, van trailers have increased actually more than what we've seen trucks increase. So no different than the way I look at trucks, I look at trailers, 53-foot trailers, in a similar fashion. Just looking at 8 to 15-year-old trucks, in comparing the last 6 years of sales versus our live sales. We've seen an average of $17,500 increase, and that almost is a 232% increase. And the highest increase was on a 10-year-old trailer. The average was about $13,000, the 6-year average prior to 2021. And in 2021, we were just under $31,000. That's a $22,000 increase and about 275%. Just realistically, that trailer is selling more used than it sold for new 10 years ago. You know, and that blows me away, right? We are seeing that on tractors. We see 3-year-old units selling for more than what that new truck would cost today. We saw triaxles go for $50,000 more than a brand new triaxle would go for in some of our truck sales. We saw dump trucks go for $60,000 more than what it sold for brand new. So the numbers are just amazing. And you know, if you want to see any of those numbers, you can jump on our website. If you have an account, you can jump on and take a look at some of our results. Easily accessible.
Yep. And we also make them accessible in the market trends reports, which you can subscribe to, as well as the pricing tools that we have out there. So once again, we do this for all sectors, and we know that the prices in the yellow iron space are, we're seeing the craziness there. We're just not seeing this type of crazy. This is the sector where we see the most craziness, right? If you want to put it all in perspective. So Steve, jumping back to you, let's talk a little bit about, what we're seeing from the cycle. Or we're going to talk about refurb first. Excuse me. So, Josh, I know, getting trucks ready to sell, right, has a huge impact on pricing. So why don't you take us through some of the options that are out there for folks?
Absolutely. I'll kind of break it down in 2 ways to answer this. So refurb definitely has an influence on the value of the used truck or trailer. I always recommend to the customer doing a cost-based analysis when they get the asset, seeing what it would transact for as is, tallying what the recommended refurb is, and seeing if there's a higher net return for them doing the proper refurb to get it frontline ready. When you remarket an asset in the as-is condition, you do limit your buying base, because not every customer has the ability to refurb or timing to get that unit ready. If they're going to pay for it, they need it to go on the road and start making money immediately. So that's going to influence the price of the asset. There are significantly more buyers willing to pay the premium when it's considered frontline ready. During this current market, normal wear and tear is still acceptable. It has not changed. However, dash lights, so your engine, transmissions, etc., that is having the largest impact on the decreasing of selling price. It is significant. In the current market, performing some of the refurb is not possible due to the parts shortage. Worked with some major fleets that have actually kind of done a pull apart situation, that they've cannibalized one truck so that they can get some parts off to remarket some trucks, bring them to auction, etc. Dealer groups that I've spoken with throughout the country are still practicing their same pre-COVID practice on the refurb to make sure that they're maximizing their net returns on their assets as well. So in summary, doing refurb definitely pays. And it definitely has an impact on the net return of the asset.
Yeah, no, it's interesting. I mean, I think one of the things we've seen, with the pandemic is the increased presence of end user buyers at our sales. So, somebody who's gonna try to put this to work right away, and having that, truck that's ready to go is important. We see when you're selling it, through these types of channels. So good stuff there. Now, Steve, you want to take us, back into some of the macro stuff about, how things are moving with trade cycles?
Yeah, sure. Happy to do that. So, one of the comments that Rob made, when he was looking at his 2016 Freightliner, was he's controlling for age there, or I guess he's not controlling for age. He showed you what it looked like when the truck was 5 years old, and now what it looks like today when it's 7 years old. So we do something a little bit. We do that, but we also do something a little bit different. We actually look at age-based calculations. So what you're looking at in this particular slide is just the average age, and this is all the Class 8 truck sales that are reported into us or that we collect on a monthly basis. So it's all makes, all models, all specs, no regard for any mix, if you will. And so what you're seeing, I've thrown a trend line on there, and you can see, as folks were interested in getting out from under their equipment, they were trading them sooner rather than later back in that 2019, 2020 timeframe. COVID hits, and trucks were parked, right? They were underutilized. You can slow down the odometer, if you will, the mileage, but you can't stop the clock. The clock keeps on ticking, and so we're seeing the backside of that curve right now. Again, going back to the lack of availability of new equipment. If a fleet is ready to trade out a truck and the truck's not ready for delivery, what do? Well, they're not getting rid of it. They've got freight to haul, so they're hanging on to it. Hanging on to it was beyond what their normal trade cycle is, or between longer than this agreement. And so certainly since I'll say late 2020, all through 21, you saw age trending up. You get a lot of noise in there. It just depends on, again, what the mix is from one month to the next. And that's why I threw the trend line on, so you can see kind of the general direction. But it's a comment that we hear, from all of the fleets, all the sources that we're talking to. I'm extending my trade cycle because I don't have a choice. And so as those trucks filter then into the secondary market, you see the results of them having held on to those trucks longer. The other comment that I would make kind of dovetails with what Josh was talking about, and something I said earlier, about us starting to see that prices nibbling away or getting smaller at the margin. The older truck, the higher mileage truck, the unreconditioned truck, all those are going to be some of the trucks that, when things start normalizing even more, are going to be sitting on the lot maybe a little bit longer, and you're going to see, lot rot or price depreciation, or however you want to think about it. And so that's a factor I think that the potential sellers need to keep in mind. We think, if just looking at this, the dynamics right now, because we expect to see constraints continue through the better part of this year and into next year, I think you're going to see this continue. I think you're going to see folks holding on to trucks longer than they traditionally do. And I want to dispel a rumor. Not every fleet trades its truck at 3 or 4 years, right? Sure, you get those large national accounts. They're not set up to do maintenance. All their maintenance is under warranty, so they just take it back to the dealership or the authorized service station and have the work done. But you have other cohorts of fleets out there that hold their trucks much longer. The private fleets are a great example, right? They're not a revenue generating business. They're a cost center, or maybe a cost avoidance center. And so they have different hurdles about how long they have to hang on to their trucks to get their money back or to get their payback. So at a private fleet, a 7 or 8 year trade cycle is not at all unusual. And that's kind of the sweet spot that we see in some of the used truck data that we look at. Tends to average right around that range. The less than truckload guys, a lot of them are still set up to do their own maintenance. So they have shops, they have mechanics, they've got spare parts inventories. You want to do an in-frame overhaul? No problem, bring it in. You want to do an out-of-frame overhaul? Well, let's talk about it, but it's not an immediate no. You remember there used to be a story, UPS. They had a 20-year trade cycle on their package cars, right? And they didn't sell their trucks at the secondary market. They put them in a crusher and they squeezed them into a metal cube, and then that cube went back to the smelter so it could be made into metal for another new truck, I guess, or tin cans. I don't know what they made out of them, but so a 20-year trade cycle, if you. So it runs the gamut. We have everything out there that you could possibly imagine. So. Well, I've got one other slide here that speaks to trade cycles changing. And, one of the things that impacts trade cycles is regulation. And of course, we have, probably more than our fair share. We're an easy target to point at. You see a long and tall burning down the highway, belching black smoke, and, you get all the regulators in an uproar. But in particular, California, but also to a lesser degree right now anyway, the EPA have a number of mandates that are either in place and phasing in, or some new ones coming down the pike at us that are going to have an impact on trade cycle. On the top of that chart, and I apologize, it's a little bit of an eye chart. In particular, California, the Air Resources Board out there, or CARB, has what they call an omnibus regulation, and then they have the Advanced Clean Truck regulation. And both of those are set to go into effect in the kind of 2024, 2025 timeframe. And both of them are adding basically higher costs to the truck, right? So we're gonna make the trucks even cleaner than they are today. We're gonna go after NOx, we're gonna go after more greenhouse gas. So you're also, as part of that emission solution, going to see new equipment on the truck, which drives that price up. But it also brings with it uncertainty about reliability, about durability, about performance of the trucks, about residual values. What's this thing going to be worth, 5 years hence, or whenever I go to trade it? We have a really good precedent for emissions mandates like this. Typically what happens is you have a good portion of the fleet that says, hey, I know what's going to happen. I don't want to be the beta tester. I don't want to pay the increased price now. So I'm going to compress my trade cycle, right? I'm going to shorten it up, which means we're going to see trucks coming into the secondary market ahead of these mandates in 24 and 25. So we'll have to keep an eye out to see, what the economic conditions are in that time frame and what the supply of used trucks in a few years looks like. But this carries with it the potential to, increase the supply of used trucks, and of course, send rates even lower. Unfortunately, is the upshot. Now, it is a cycle, right? So there's always an upside or a downside, however you think about it. So eventually they come back to the marketplace. And depending on what the economy is going to be doing in that time frame, I don't know what your crystal ball looks like. Mine's a little opaque that far out, but it
I
may
think
be
that's our next and last slide is the crystal ball. So, I think I know we always try to ask this question because it's forefront in people's minds. Hey, when is a good time to sell? When is a good time to buy? I mean, yep. I think, if you've been a seller, right, the past year and a half or so, it's been an amazing time. But, as you said sort of before, this is kind of, we're at the length of this cycle is getting out there. And any predictions?
Yeah, so I think the easy part of this question to answer is what the market looks like. You essentially move closer to harmony or to balance or to equilibrium. I think all words that I've used earlier in the conversation. So a normalized market is maybe the way to think about it. The harder part of this question to answer is the when, right? When is that going to happen? Yeah. I mentioned, especially you think about the semiconductor thing, we thought we were making progress and getting a leg up. It's not just us, right? Look at the car industry. There were announcements from the car manufacturers last week. Hey, we're closing our plant because we can't get supply. We can't get semiconductor chips. And it's just so frustrating because there's not good visibility to even something that's in the headlines almost every day on a global basis. And then you get down into those, less sexy parts like the wiring harnesses that Rob talked about, or just, gray metal castings, tires, for crying out loud, oil, everything. You saw my watch list, the things that we're focusing on. So I used to, I don't know if I showed it on this in an earlier presentation, but I had a whack-a-mole, right? So that's what it's like. Yeah. It's like, you fix one problem and then boom, another one springs up over here. You take care of that and you're on to the next thing. So it's good that this industry is as energetic as it is and as creative as it is, because we're finding solutions to an awful lot of this stuff. It's just that there's so many things that we have to focus on right now to get things going. So, I mean, great grand scheme of things, you know, especially in the secondary market. My guidance, what you need to do right now is just be careful. If you're buying, you know, you don't want to buy it at the top. That's not the place you want to be. So you need to be a little bit conservative. But at the same time, you know, it's not time to close up shop and go home. You still need to buy, because we're still going to need trucks. We're still going to have demand for trucks. So that's unlike how I play the stock market. You know, you need to buy low and sell high.
Well, let me maybe, you know, maybe we can end it with a simpler question for all you guys out there. Is Tiger going to play the Masters?
Yeah,
He's probably announced it.
You were looking for a yes/no answer, but my answer is I sure as heck hope so.
Yeah, exactly. Well, no, this has been great, guys, as always. Appreciate the time. Some really good nuggets in there. You know, we'll break this up as always and get this out there on social media so folks can listen to it afterwards. Always enjoy having you guys on. Always enjoy the insight. This is something we're going to keep doing. I think it's look, we can't, you know, I wish we could predict, but what we, you know, and that's, you know, like you said, my stock market pickings is probably about as good as yours. But I think at the end of the day, we can try to give folks out there the best information they can get at, and then, you know, allow them to make the decisions. But, you know, certainly this is a market, you know, I'm going to defer to all you guys. This is a market we haven't seen the likes of, you know, in the history of doing this. So, you know, it's just, you know, we've seen a lot of sellers lately who are doing pretty well and selling their vehicles or their, you know, any heavy equipment right now. So once again, thanks everybody. Thanks for joining us. That's a wrap for today. Stay safe, stay warm. You know, and enjoy the Easter holidays coming up, and we'll be back at you soon. Bye everyone.
Thanks, guys.